Welcome to the second video in the Rubix Financial Ratios series. In our earlier video, we had told you about the various kinds of ratios that help assess the financial health of a company. Today, we'll talk about solvency ratios in particular. Solvency ratios are also called leverage ratios. These ratios indicate whether the company's cash flows are adequate to meet its long-term financial obligations. Let's look at some of these ratios now. The debt-to-equity ratio shows the weight of the company's total debt and financial liabilities against the total shareholders' equity. This ratio shows us whether the company's capital structure is based more on debt or equity financing. In general, if a company's debt-to-equity ratio is too high, it's a signal that the company may be in financial distress and unable to pay its debtors. On the other hand, a very low ratio indicates that the company is not using debt financing optimally. The interest coverage ratio is used to determine how easily a company can pay interest on its outstanding debt. The higher the interest coverage ratio, the lower the risk of the company defaulting on its interest payments. The debt to EBITDA ratio measures the amount of income generated and available to pay down debt before covering interest, taxes, depreciation, and amortization expenses. It indicates the ability of a company to pay off its debt. A high ratio could mean that a company has a very heavy debt load. The fixed assets to total net worth ratio is the share of the company's assets that are tied up in fixed assets such as property, plant, and equipment. It indicates the proportion of the company's assets that cannot be used as working capital. If the fixed assets to total net worth ratio is too high, it indicates that the company is vulnerable to unexpected events. The total outside liabilities to total net worth ratio indicates a business's reliance on debt. The lower this ratio, the lower the risk. The sales to net fixed assets ratio helps gauge how efficiently a business uses its fixed assets to generate sales. This is also called the fixed asset turnover ratio. A high ratio indicates more efficiency in utilization of existing fixed assets to generate sales. The current liabilities to total net worth ratio quantifies the risk that short-term creditors are taking compared to the risk taken by the company's owners. This ratio reflects a level of security for creditors. The higher the ratio relative to industry norms, the lesser the security there is for short-term creditors. Solvency ratios provide an insight into a company's financial stability and ability to meet its long-term obligations. Investors and analysts need this information to assess the financial risks of a company. That's a short guide on solvency ratios. Please subscribe and follow Rubix Data Sciences for more such videos.